What if the 2026 market crash isn't something you can avoid, but something you can actually profit from? Most investors are focused on timing the crash or hiding from it, but that's the wrong approach entirely. The real danger isn't the crash itself. It's being positioned in the wrong assets when it happens. Today, we're not going to predict the exact date or trigger. Instead, we're going to identify the only 3 asset classes that have historically not just survived systemic collapses, but thrived during them. This isn't about preservation. It's about identifying where wealth will flow when everything else fails. The fundamental problem with most investment strategies is they're built for normal market conditions. Modern portfolio theory, with its emphasis on diversification across stocks and bonds, works until it doesn't. During a true systemic crisis, correlations between asset classes tend to converge toward one. What was diversified becomes concentrated risk almost overnight. Take blue chip stocks. During the 2008 crisis, even historically stable companies saw their values cut in half or worse. The assumption that they'll always bounce back ignores the reality that some companies don't survive the downturn. Their debt loads become unsustainable, their revenue evaporates, and what was once considered a safe haven becomes a liability. Bonds present another illusion of safety. In a scenario where central banks are forced to combat inflation with rising interest rates, bond prices fall. The traditional stock-bond diversification model breaks down precisely when you need it most. And cash? During periods of high inflation, which often accompany economic crises, cash loses purchasing power rapidly. Holding too much cash means watching your wealth erode day by day. The tech sector is particularly vulnerable. These companies are often valued on future growth expectations. When liquidity dries up and risk appetite vanishes, their valuations can collapse dramatically. Many tech companies also carry significant debt to fuel growth, making them fragile when credit markets tighten. Real estate faces what might be the perfect storm. High leverage, shifting demographic trends, and the potential for rising vacancy rates create a dangerous combination. Unlike previous crises, the commercial real estate sector enters this potential downturn with unprecedented debt levels and changing work patterns that question the very foundation of office and retail property values. The common thread here is debt and dependency on continuous economic growth. Conventional assets are priced for a world that keeps expanding. When that expansion stops abruptly, the assets most dependent on it suffer the most severe corrections. So what actually works when the system falters? We start with assets that people need regardless of economic conditions. Commodities with inelastic demand. Inelastic demand means consumption doesn't change much when prices change or when incomes fall. People might cancel their streaming subscriptions and delay buying a new car, but they still need to eat, heat their homes, and power their essential devices. Agricultural commodities are the foundation here. Wheat, corn, soybeans, these aren't discretionary purchases. During the 2008 financial crisis, while the S&P 500 fell nearly 40%, agricultural commodities experienced much smaller declines and recovered more quickly. The Great Depression showed similar patterns. Food production and consumption continued because eating is non-negotiable. Energy is another critical category. Society literally cannot function without power. During economic contractions, energy demand might soften slightly, but the baseline consumption remains robust. What's particularly interesting is energy infrastructure, companies involved in transportation, storage, and distribution. These assets become bottlenecks during crises, often allowing them to maintain pricing power even as other sectors collapse. Precious metals beyond gold deserve attention. While gold is the traditional safe haven, industrial metals like silver, platinum, and palladium have unique characteristics. They're stores of value like gold, but they also have essential industrial applications. This dual nature can provide stability during the initial crisis phase and growth during the recovery phase, as industrial production ramps up again. The key to accessing these commodities without the complications of physical storage is through futures contracts, commodity ETFs, or shares in companies with strong operational control over production. The timing is critical. Entering these positions too early can mean sitting through periods of underperformance, but waiting until panic sets up means missing the optimal entry point. The ideal approach is gradual accumulation during periods of market stability, building a position before the crisis becomes obvious to everyone else. Now, understanding which assets work is only half the battle. The other half is overcoming the psychological wiring that causes most investors to fail precisely when opportunity is greatest. When markets begin their descent, the most natural human instinct is to flee to safety. That usually means selling everything and moving to cash. It feels like the prudent thing to do, to wait on the sidelines until the storm passes, but this is the trap. In a true inflationary crisis, cash isn't a safe harbor, it's a slowly leaking lifeboat. Your purchasing power erodes while you wait for a bottom that is impossible to identify in real time. The second part of this trap is the fear of catching a falling knife. Investors become paralyzed, watching prices fall and telling themselves they'll buy when things look better. But by the time things look better, the best opportunities are long gone. The most profitable entries happen when headlines are at their most frightening, when the emotional pain of losing money is most acute for everyone else. The investors who profited immensely from the 2008 housing crash weren't those who bought after the recovery began in 2012. They were the ones who started acquiring distressed properties and bank assets in late 2008 and 2009, when the financial world seemed to be ending. Their mental shift was critical. They stopped thinking about preservation alone and started thinking about strategic accumulation. They saw panic not as a signal to hide, but as a signal that quality assets were being sold at irrational prices. This contrarian mindset is uncomfortable but essential. It requires you to act against every emotional impulse telling you to run away. This brings us to our second asset class, which is arguably the most powerful for weathering a prolonged downturn: defensive infrastructure with monopoly characteristics. These are businesses that form the absolute bedrock of modern society. Services so essential that their demand doesn't just remain stable during a crisis. In some cases, it can even increase. Let's start with utilities. Think about your electricity, water, and natural gas providers. These are often regulated monopolies or oligopolies with incredibly predictable revenue streams. People might cut back on dining out or cancel vacations, but they will always pay their utility bills. The lights stay on, the water runs, and the house stays heated. During the 2008 crisis, while the broader market plummeted, utility stocks significantly outperformed. Their regulated nature often means they have guaranteed rates of return, providing a cushion that other industries lack. They become defensive bastions that generate steady cash flow regardless of the economic weather. Next, consider telecommunications. In the 21st century, access to the internet and mobile networks is no longer a luxury, it's a utility. It's the backbone for communication, remote work, education, and even emergency services. During a lockdown or a period of economic contraction, reliance on these services often increases. While consumers might downgrade plans, the baseline subscription remains intact. These networks represent massive, irreplaceable infrastructure investments with high barriers to entry, creating natural monopolies or duopolies in most regions. This pricing power and inelastic demand create a formidable defense. Then there's healthcare. Healthcare spending is largely non-discretionary. Medical emergencies, prescription drugs, and essential treatments are not postponed because of a recession. In fact, stress-related health issues can sometimes increase during economic downturns. Companies involved in essential healthcare services, medical supplies, and pharmaceuticals represent another layer of defensive infrastructure. Their services are needed in good times and bad, making them resilient anchors in a portfolio. The key to selecting the right companies within these sectors is to identify those with true monopoly characteristics. Look for businesses with high barriers to entry, regulatory protection, and pricing power. A local water utility is a better bet than a trendy tech company claiming to disrupt utilities. A major telecom provider with existing infrastructure is safer than a new entrant. Geographic diversification matters too. While the U.S. market might be stable, having exposure to essential infrastructure in other developed economies can provide an additional layer of protection against country-specific risks. Finally, don't overlook the dividend advantage. These types of companies often pay consistent dividends, providing a valuable income stream during a period when other sources of revenue might dry up. This cash flow can be reinvested at depressed prices or used to cover living expenses, turning a defensive position into an offensive tool. So you understand the assets, but timing is where most people get it completely wrong. Buying these defensive positions during calm, stable markets misses the entire point. The goal isn't to get a small, safe return, it's to build a position that will perform when everything else is collapsing. The contrarian edge comes from understanding that being early feels the same as being wrong, until suddenly you're right. The perfect entry point isn't a single moment you can pinpoint on a chart. It's a process. Instead of trying to time the exact bottom, which is a fool's errand, you build a staggered entry strategy. This means allocating your capital in phases. You might put a third of your intended allocation to work when certain technical indicators flash warning signs, like a sustained breakdown of major market support levels or a significant inversion of the yield curve. These aren't predictions of immediate collapse, but signals of increasing instability. You add another third as volatility spikes and panic begins to set in headlines. The final portion is reserved for when fear is at its absolute peak, when the financial news is overwhelmingly negative and it feels like the worst possible time to buy. That's usually when you're getting the best prices. The key is to avoid the paralysis of perfection. You won't buy at the very bottom. You might buy something that continues to fall 10, 15, even 20%. But if you've chosen assets with fundamental inelastic demand, that temporary paper loss is irrelevant. You're not trading for next week, you're positioning for the next 5 years. The mental preparation is just as important as the financial preparation. You have to be comfortable with discomfort. You have to be willing to see red in your portfolio while everyone is screaming to sell. That's the price of admission for acquiring assets at generational lows. Now we come to the third and most controversial asset class: strategic cash flow machines. These are the businesses that don't just survive a downturn, their business models can actually improve during one. They thrive on the distress of others. This is where the line between defense and offense becomes blurred, and it's crucial to approach this with a clear understanding of both the mechanics and the ethics involved. The first category is distressed asset management and debt collection. When companies and individuals can't pay their debts, their obligations are sold for pennies on the dollar. Specialized firms that have the expertise and the stomach to navigate bankruptcy courts and negotiate with distressed sellers can acquire assets, whether it's a company's equipment, a loan portfolio, or real estate, at a fraction of their intrinsic value. During the 2008 crisis, the most successful hedge funds weren't the ones that shorted the market. They were the ones that had dry powder ready to scoop up high-quality assets from forced sellers. This requires significant capital and expertise, but for the average investor, there are publicly traded business development companies and certain ETFs that provide exposure to this strategy. The second category is essential consumer finance. This includes businesses like payday lending or basic banking services for segments of the population that remain underserved by traditional banks. In an economic downturn, demand for small-dollar short-term credit often increases as people face cash flow squeezes. While this is a sensitive area with valid ethical concerns, the economic reality is that these services fill a need. The key is to look for companies that operate with transparency and within regulatory frameworks, rather than predatory lenders. Their cash flow can become incredibly stable when traditional lending dries up. Then there are bankruptcy and restructuring services. When large companies fail, they don't just disappear. They go through complex legal processes managed by law firms, consulting firms, and turnaround specialists. These service providers are paid fees throughout the process, often from debtor-in-possession financing, meaning they get paid before other creditors. Their workload and their revenue increases precisely when the economy contracts. Investing in the firms that provide these essential ambulance services is a way to profit from the restructuring cycle without taking on the direct risk of the distressed companies themselves. The window for these opportunities is often limited. The most profitable period is typically the early stages of a crisis, when the wave of distress is just beginning, but the systemic risks are being contained by policymakers. Identifying these opportunities requires looking at leading indicators like rising corporate default rates, increases in bankruptcy filings, and tightening lending standards. It's not about celebrating misfortune. It's about recognizing that in a market economy, the process of creative destruction creates opportunities for those who understand the entire cycle, not just the growth phase. So how do you actually put this all together? It's not about just buying one of these assets. It's about building a balanced system. Your allocation depends entirely on your risk tolerance and timeline. A conservative investor might put 40% into defensive infrastructure, 40% into essential commodities, and 20% into the strategic cash flow opportunities. A more aggressive investor might flip that with a heavier weighting toward the opportunistic assets, accepting more volatility for potentially higher returns. Geographic diversification within each bucket is crucial. Don't just buy a US utility ETF. Look for exposure to regulated infrastructure in Europe and developed Asia. For commodities, consider global supply chains, not just domestic producers. This protects you against region-specific political or economic shocks. Liquidity is another key consideration. In a true crisis, you need to ensure you can access your funds. Some commodity ETFs can face challenges if the underlying physical market seizes up. Similarly, some distressed debt funds may have lockup periods. Always maintain a separate liquid emergency fund for living expenses outside of this investment portfolio. As the crisis unfolds, you need rebalancing triggers. If your essential commodities allocation has surged while infrastructure has lagged, you might take some profits from commodities and add to infrastructure to maintain your target balance. This forces you to sell high and buy low systematically. Finally, be aware of the tax implications. Gains on commodities held less than a year are taxed as ordinary income, while qualifying dividends from infrastructure stocks may get preferential rates. Structuring these holdings in tax-advantaged accounts where possible can significantly improve your net returns. With a plan in place, you also need to know the pitfalls. The biggest mistake is overconcentration in a single safe asset. Putting everything into gold or a single utility stock defeats the purpose of a diversified defense system. The second mistake is underestimating how long an economic contraction can last. The recovery from 2008 took years. The next crisis could be prolonged. Your strategy must be built for endurance, not a quick rebound. Never forget counterparty risk. That ETF you bought is only as good as the institution backing it. In a systemic event, the solvency of financial intermediaries can't be taken for granted. Similarly, using leverage in this environment is extremely dangerous. Margin calls can force you to sell your best assets at the worst possible time. And perhaps the most common error, becoming so focused on your investment portfolio that you neglect your personal liquidity. If you don't have cash set aside for 6 to 12 months of living expenses, you may be forced to liquidate your strategic positions at a loss just to pay your bills. That completely undermines the entire strategy. What's coming isn't just about wealth destruction. It's about a massive transfer of wealth. Your preparation is what separates you from being a victim of that transfer to being a beneficiary. These three assets provide the defensive foundation and the offensive capability you need. Your immediate next step is to review your current portfolio's exposure to these areas. Subscribe to this channel because in the coming weeks, we'll be doing a deep dive into each one of these asset classes with specific tickers and entry strategies as market conditions develop.